In 2009, an exchange-traded product launched that would go on to lose 99.9% of its value. Not in a crash, not in a fraud. The stock market it was tied to spent most of those years going up. A hypothetical $10 million parked in this product at launch and left alone would have shrunk to less than $12. The product is VXX, a note that holds volatility futures, and its decay is not a malfunction. It is the product working exactly as designed, paying a toll day after day to whoever stands on the other side. The toll booth is called the VIX term structure, and it may be the most persistent cash register in modern markets. This video is about how that machine works and about the day it broke. Start with the shape itself. The VIX measures how much movement index options expect over the next 30 days. On July 2nd, it closed at 16.59. Its sister index, VIX 3-month, measures the same expectation over 3 months, and it closed at 19.04. Look at what that pair of numbers is saying. The market charges more for volatility further out, even when nothing specific is scheduled out there. Plot expected volatility across time from 30 days out to the strip of VIX futures stretching months ahead, and you usually get a line that slopes upward. Traders call that shape Contango. When the line flips and slopes downward, that is backwardation, and it means the market fears right now more than later. Which shape the curve is in tells you which volatility regime you are living in, and, more importantly, who is getting paid by whom. Why would the curve slope upward most of the time? Because forward volatility is insurance, and insurance sold in advance carries a premium. The seller of a volatility future is agreeing today to absorb whatever panic shows up months from now, and they charge for that uncertainty. Since 2007, the VIX futures curve has been in Contango roughly 75% of the time. Now watch what that does to any product that must hold these futures. A note like VXX cannot own the VIX itself, because the VIX is just a calculation, not a thing you can buy. So it holds the nearest futures contracts, and as those approach expiration it sells them and buys the next month out. In Contango, the contract it buys is the expensive one further up the slope, and the contract it sells has spent weeks sliding down the curve toward the lower spot price. Sell low, buy high, mechanically, every trading day. In calm markets, that roll erodes roughly 4 to 6% of the product's value per month. Compound that for a decade and a half and you arrive at the 99.9% loss from the top of this video. Nobody stole the money. It drained out through the slope of a curve. So who collects the toll? Whoever takes the other side of the roll. Traders and funds that are systematically short volatility futures, harvesting the gap between the insurance price and the con that usually follows. For years, this looked like the most dependable trade in markets, and money piled into products that packaged it, including inverse notes that went up a little almost every day as the curve did its work. Here is the quant wedge, the part that turns a quiet carry trade into a system-level event. Those inverse and leveraged volatility products have to rebalance at the end of each day to reset their exposure, and the mathematics of that rebalancing points the same direction for both of them. When volatility rises, both the inverse products and the leveraged long products must buy VIX futures into the close. The bigger the day's move, the bigger the forced buying. By early 2018, the short volatility trade had grown so large that this rebalancing demand was itself capable of moving the VIX futures market. On February 5th, 2018, the S&P 500 fell about 4.1%, a bad day but nowhere near historic, only around the 31st worst since the VIX began. The VIX itself, though, rose about 116%, roughly 20 points, the largest one-day percentage and point jump in its history. The gap between a routine stock decline and a record volatility explosion was the machine. Rising volatility forced the products to buy volatility futures, which pushed volatility futures higher, which increased the amount they had to buy. The insurance market briefly set its own price on fire. Analysts at the Bank for International Settlements later reconstructed exactly this loop, hour by hour, through the futures order book of that afternoon. The most famous casualty was Roman 14, an inverse volatility note that had been one of the best performing products in the market during the calm years. Its prospectus contained an acceleration clause. If the note ever lost 80% or more of its value in a day, the issuer could terminate it. On the evening of February 5th, as the forced rebalancing tore through the futures market after the cash close, the note's indicative value collapsed by roughly 96%. The clause was triggered, and within weeks the product was gone. Investors who had watched it grind higher for years were left with a lesson about what the Contango premium had been paying them for all along. The curve was never offering free income. It was offering compensation for standing in front of exactly this kind of day, when the curve snaps into backwardation and the years of collected tolls are handed back in hours. So read the VIX term structure the way professionals do, not as a forecast, but as a regime dial with two settings. In Contango, the ordinary state, forward insurance costs more than spot fear, long volatility products bleed by construction, and the sellers of that insurance collect a steady toll for carrying catastrophic risk. In backwardation, the crisis state, the dial has flipped, the market pays up for protection right now, and the carry that took years to accumulate can be repaid in a single afternoon. Neither state tells you where stocks go next. What the curve tells you is what the market is charging for time, and which side of the insurance counter you would be standing on. If you want more breakdowns of the machinery underneath the market, subscribe for the next one. This has been educational content, not financial advice.